Record. All right, we are live. Fantastic. So, a couple of reminders for everybody who's in the call today. As usual, we begin with the session doing introductions and the prepared remarks from our presenters. Then we will move into our Q&A session and then leave some time at the end for networking in the breakout rooms. Second thing, for those of you who are interested in the webinar raffle, if you ask one question during today's Q&A and stick around for the networking, you will have your name entered into the raffle pot. You can earn one entry at each subsequent webinar by doing the same, asking one question and sticking around for networking. And the raffle winner will be drawn after the December webinar. And the big prize is, well, I can't tell you that yet, can I? Probably not. So you'll just have to wait and see. But I promise it's a good prize. As always, our presenters and the executive team would love to see your lovely faces. So if you can, please turn on your cameras and let us see the faces behind the actuarial minds of tomorrow. And as I mentioned before, this webinar is recorded and will be uploaded to YouTube for any of those who could not attend tonight's session or who wanted to review something later on. With that, I will turn it over to our guests, Phoenix and Kieran, for their introduction and their presentation.
Thanks so much, Daniel. Welcome, everyone. Thanks for joining us after school for those on the East Coast or Eastern time zone, and during school for those that are in the West. So we appreciate the time and joining. Looks like we got quite a few folks in here, so that's always nice to see. So I'm going to start sharing my screen here if I can figure out how to work it. There we are. Let's see. Hopefully that works. Everyone can see.
Yes.
Perfect. So, yes, like Daniel mentioned, today Phoenix and I are going to talk to you a little bit about property and casualty insurance, or P&C as it's more commonly called. I'll give a quick rundown of the agenda and then we'll get into it. But we wanted to really just introduce everyone to property and casualty insurance. I think it's a less well-known part of being or option for a future actuary. And we're both in the P&C industry. I know usually there's a lot of exposure to life insurance through courses and networking and sponsors and those sorts of things. But yeah, P&C is a very interesting world, and we just wanted to share some of the things that yeah, that you might encounter, teams you might encounter, and roles you might have if you want to try and take on the wonderful world of P&C. So today we'll be given some introductions. So I'll introduce myself, Phoenix can introduce herself. Then we'll give you an overview of some of the property and casualty departments that you'd work with as an actuary, just to give you an idea of the kinds of functional areas that make the company really work. And then we'll give a more in-depth overview of the actuarial functional areas. So what you might be doing as an actuary, either co-op, full-time, if you get into that industry, some of the different roles that are available to you and just how different they are. And then finally, just to put it into perspective, we'll have some comparisons on P&C and life insurance. And then, as Daniel mentioned, we'll have time for questions, and then we'll get into some networking. So yeah, so maybe we can start with introductions. So I'll go first, just because I'm already speaking. My name's Kieran Hendrickson Gracie. So I'm a manager here at Definity. You may know it formerly as Economical, although that now might be too long ago for most of you that are in school. You might have never even heard of Economical. But I'm a manager in the personal lines pricing department. So I am in charge of the premiums that we charge to customers for auto insurance on their personal auto. So if you have like a car, you need insurance on it. Obviously, we have to pay premiums on that. So I'm in charge of the premiums and how we price that for the Atlantic region as well as Alberta. I've been with Definity for just over 10 years. I started as a co-op, so probably like many of you are in in right now, the position you're in a student in a co-op student. So I started as a co-op, transitioned to full-time in about 2016. And then throughout that time, I've had a number of different roles. So I've been on the reserving team, the planning team, risk management, several different functional areas. And just most recently, about the past 3 years, I've been leading pricing teams in the personal lines. So you'll hear about what some of those teams actually are and what they do later. But I'm a member or a fellow of the Casualty Actuarial Society, which is the P&C based actuarial accreditation. So similar to an FSA. For P&C, it's an FCAS. And yeah, I was a Waterloo grad, and that's a bit about my background. So maybe I'll pass it over to Phoenix.
Yeah, hi everyone. My name is Phoenix. So I've been with the company around almost 6 years right now, and then I started my career as a co-op. And then I firstly was in the pricing. So I do personal insurance and then personal auto, personal property, and then I moved into a special project which was focusing on the geographic stuff, like those cool stuff of mapping, and then to see how the geography can impact the prices a little bit. And then I'm moving to the planning team. So the planning team right now I'm at is we kind of do a forecast for the future. So we take a look of the what's the plan on the this year and the also next year, and then we work with different departments such as the pricing, reservings, reinsurance, and then we'll understand those input and how that can impact our business. Uh, and then we come up with a plan that what we're seeing in the future. And then the management team can use those plan forecast to better make business decisions, such as where we want to grow our business, where we're thinking that we maybe should take some actions on, such things like that. Yeah, so that's pretty much my background right here.
Excellent. All right, so then we'll jump into some of the departments. So entering into the property casualty insurance world, you'll be working with a number of different types of insurance. So that includes things like auto, home, business. So whether it be commercial liability, errors and omissions, all different types. Essentially, everything that's not life insurance, for the most part, falls into property and casualty. And so it's a very broad umbrella. And as a future actuary, um, you'll be part of a much larger group that sort of makes all of the different areas come together and allows you to really run this business. So we wanted to highlight a few before we really dive deep into the actuarial function. Just some of the different departments that you'd be working with, experts that you might come across, and teams that you'd really be collaborating with, just to give you an idea of the types of roles adjacent maybe to an actuary. So we'll start with the product team. So the product team, really like it sounds, is the experts on the various different products. So whether it be an auto policy, a commercial building, or even say marine insurance, they would be the experts on these. They would understand the coverages, the regulations, and all different product features. And so what their main job is to bring together a lot of the different teams, so like pricing, underwriting, risk, claims, to make sure that our products are meeting the needs of customers, meeting the needs of regulators, being priced properly, and putting all of that together. So some of the main things that an actuary might be working with the product to understand is offering a new product. So let's say we're in the auto sphere and we want to make something a telematics-based product, like usage-based insurance. They might understand what are the current regulations, what do we need to have in our policy wordings, our coverages, in order to really provide that. They might come up with some of the discount structures or the different features of the product, if you want to call it that. and then work with the teams to make those a reality. They would also be responsible for changes to existing products. So I'm sure some of you have an auto policy in Ontario, and you've seen that they're reworking what are called accident benefits. So if you get into a crash, the benefits that you're paid out. The government is currently going through a reform where they're changing those. So the product folks would be the ones leading that charge. They would be changing the policy, making sure the customers are aware, and working with the actuaries to make sure that it's properly priced and we understand the risk of this new policy. So that's a little bit about the product team. Next, we would have underwriting. So product and underwriting often go hand in hand. And underwriting is really sort of the first line of defense when we're writing new policies. So this can be something as simple as understanding what types of risks do we want and not want. Say we don't, as a company, we're not really comfortable writing brand new drivers. So we might put in some underwriting rules or some sort of appropriate roadblocks or make these types of customers phone in and make sure that they're really somebody we want. So they might be doing something simple like that, whereas they put in some rules. Or it might be something as complex as for a commercial factory going through and understanding what is the actual risk. They'd ask clarifying questions. They'd understand the exposure. So what types of risks face this business? What sorts of coverages are they going to need? Is it something within our appetite? And then, although pricing can do quite a bit, sometimes when there's very unique risks, underwriting would have some say in actually giving discounts or surcharges based on their experience as an expert on taking on and how they perceive these risks. So they could decline or accept different risks. And they'd be working with actuarial pretty closely as well to understand the impacts of underwriting decisions. So if we wanted to, say, remove all vehicles over 150,000 because those are just too expensive, too much chance for loss on those. They might work with pricing or actuarial to understand what does that do to our current book and what does that do to our potential market share. And so that's really what underwriting does. They're there to make sure we're applying our risk appetite, what we want to take and what we don't want to take, and make sure those are being put through properly. The next department that an actuary would work with, and I'm sure you've taken lots of classes about this, is the investments. So from a P&C standpoint, investments would be more of a finance-related field rather than, I know in the life side, there's a lot of investments and strategy on the actuarial side. This is more on the finance side. So a P&C company or any insurance company is going to have to hold a lot of reserves and capital requirements. Those are both to ensure that we can pay out claims and also to meet regulatory standards. And what that means is that we have a significant amount of money to invest, and we don't want to just let it sit in a savings account or a checking account and then pay out as needed. This is money we can be using to actually invest and make returns on. So it's another stream of income that an insurer can have. What the investment team is going to do is they're going to manage the risk and the investments of that capital. So they'll make sure that, one, we're meeting regulatory requirements in terms of what we can and cannot invest in. They'll be matching durations for our claims so that as bonds and come up for their principal, that those are matching when we'll be paying out claims so that we're not having to sell things and move a lot of money around consistently. And yeah, they're really in charge of making sure that our excess and reserves, excess capital and reserves are being put to good use. So an actuary is going to work quite a bit with investments because in most exercises, as you've probably seen in your classes, we take the actuarial present value of things where we discount it we take the probability of something happening. And so when we want to discount something, most of the time we use a lot of these investment returns as a discount rate. We want to see how much money should we be holding, or how much should we be pricing a policy at today, so that we can make sure we're paying out the correct amount of claims in 5 to 10 years when a injury claim might come up. So the second last one I'm going to get into is claims. And this is quite a bit different, I would say, to a life insurer. So claims for a P&C insurer can be all sorts of different types of claims, depending on what types of policies and coverages you're looking at. It could be an injury from an auto accident. It could be a flood in your house. It could be a fire at a factory, or business interruption if there's, for some reason, a business gets shut down for a certain amount of time. So the claims department is there to help people make sure they're getting covered, to help them when they need the assistance for payments, for figuring out what are next steps, organizing like rebuilds, all of those types of things is going to be through the claims departments. They're really there to ensure a positive customer experience. When something bad happens, as the only time you'll really interact with the claims adjuster, that's really when the insurance company can shine, because otherwise we're all offering more or less some of the same products. So this is where we can really get our personal experience. They also can help in various different ways, like investigating fraud. If they suspect there's something fishy going on, they can look at trends in claim patterns. So if certain types of coverages, say for an auto policy, are getting more expensive over time, they can help alert the actuary who's in charge of either pricing or reserving, and we can include those into our assumptions going forward. And then finally, they'll be the first ones to set case reserves, or estimate how much they think we're actually going to be paying out on different claims. And that helps an actuary to assess the total liability that a company may face. So the very last one I'll go over quickly, functional area, is reinsurance. So this is very much just like regular insurance, but for insurers. So if there's areas where we're not comfortable, say for risks such as earthquake risk, or there's very high value properties, or we wouldn't want to take all of the risk on for specific types of risks, say factories. What insurance company can do is they can purchase reinsurance where there's different types of setups, where, say, we take 50% and the reinsurer takes 50% of the risk, and we split that. That allows us to increase our capacity. We can write more. It may prevent from catastrophes. So if there's floods or wildfires, maybe the certain level of losses, we send those to the reinsurance and they cover those for us. And so that can help from volatility year over year. And so reinsurance is largely an actuarial function. They look at what is our risk, what are we comfortable keeping on our book, and what do we need to offload, or what allows us to operate as best as we can. And so with that, those are the sort of functional areas that are actuarial adjacent. I'll pass it over to Phoenix now, who's going to talk more about specifically the actuarial functions.
Yep, thanks, Kieran. Yeah, so for the actuarial, how we are kind of adding those key area here. So I will talk about the pricing components, the reserving, and then the analysis side, and then the other departments that involve actuary to work on. So go to the next slides. Yeah, on the left-hand side here, we see that there's a quick example of a pricing. So just a reminder. So what is pricing really do? So pricing is like we decide how much we charge for each customers. So that's basically what pricing is doing. And then there's two key components. One will be indications, and then the second one will be segmentations when we do our pricing. So first of all, in terms of the indication. So what indications really means that it tells us that how much insurance price should go up and down based on the expected costs. So for example, there's a 5% indications. It means that, well, our current premium is too low and then we should increase 5%. So that will be what indications means. So it's you can thinking as an overall kind of indicate. And then what segmentations really mean here? So segmentation is more focusing on those small group. So segmentation is the process of dividing the customers into a small group in a similar risk characteristic, such as similar age, similar locations, similar driving history. So for examples, younger driver may be placed in a higher risk segments, and then older driver will be placed in a lower risk segments. And then what it has impact on the price is that it leads to a higher premium charge on the younger generations, and then the slightly lower premium charged to the older. But all the analysis is based on the data analysis results. So how this like indication and segmentations can impact in pricing is that, as I mentioned before, indication is more an overall kind of the view, like overall we adequate or not. And then the segmentation will be focusing on each small group that do we need a small tweaks on each group, and then in that way altogether we just ensure that the pricing is accurate for the individual and also it's sufficient for the whole player in a way. And then next we'll move to on the right hand side of reserving. So here is give you a little example of if a claims happens, so what's the component of the losses here. So as you can see, we have the incur losses as when claims came in, but there are some certain part there is the IBNR, which is incur but not report. So reserving, the major of the reserving, the actuary reservings they are using different method to estimate the IBNR parts. And then it kind of tells us that how many money we should set aside today in order to pay off the claims in the future. So give examples that if there's a car accident happens now, but there's still some amount of money that we need to hold in the company in order to fully pay it off. So that will be an actuary in reservings kind of to the main work to analyze the past claim data and then the trend, and then to estimate how much money that we should hold on. Yeah, so that will be the two kind of several examples that what an actuary do in the pricing and reserving. And then I will move to the next slide, talk about how this unpredicted analysis. So usually we build up a lot of like a modeling to make up decisions. So as an actuary, I was thinking we are a group of people that we are capable of building different modeling, and also we are able to provide solutions that help to solve those business decisions. So give you a quick example is that such as underwriters, they will ask us to identify, can you tell me that where is the high risk and where is the low risk? So what we can do, we can using some classification method to solve that type of problem. Another example I can giving you is like such as there's a claim departments are asking us that, wow, do you know, I want to understand how is our claim frequency and severity changes. Then we can build up a GRM model to answer that type of questions. And then also sometimes we come across some open ending problems. There's no solution. They just can you explain something to me? Or and then you can just create your own, let's say, machine learning model in order to answer those questions. That will be several examples on the predictive analysis doing. And then there's other functions that an actuary can do, is such as the planning. So that's what my team is currently doing, is that we just kind of forecast what's the company future loss ratio looks like, according to some information from the pricing, reserving, reinsurance, and then underwriting, etc., to build up a financial plans, and then it can help company to understand the expected performance and then the overall business, how it looks like. And then also we have something like a ERM team, the enterprise risk management team. So this actually can heavily involved in this team as well. So what this team does is that it will be stand at an entire company point of view to see that are we financial stable enough, or how's our company's performance. So for examples that the ERM team can detect some high exposures on the Wi-Fi, and then they will recommend that, oh, maybe we need to um, purchase some reinsurance contract in order to protect our company in a way. And also that actually can also play a key role at the catastrophe modeling. So this catastrophe modeling, we do a simulations model. We kind of mimic what's the earthquake, or what's the floods, or what's the hurricane. If those um, risk happens, how does it impact the company, uh, and then how much money that the company may lose if those extreme events happen. So actually can kind of working on those, build up those simulates a model, and then tells different stakeholders to understand that, well, the business impact of this. Yeah. So I will move to the next one. So the next one here is really comparing what's the differences between the life and P&C. So the first of all is the event reporting. So on the life side, the life will be reported immediately, because that, let's say someone just died, and then you're gonna report that right away. However, in P&C, there are some cases that you will kind of report uh, at the moment, such as there's a fire happening, but there are sometimes it will delay. Give you an example of that is that, let's think of there's a driver, an accident happens, but it didn't realize that it get hurts. It turns out maybe a few weeks later, and then it does hers, and then it kind of report the claim. So uh, the claim reporting, there may be some lag on the P&C side. That's one differences. And then the second point of differences is the investments. So because the feature of the P&C, sometimes we need to pay out those short-term liability. So the investments for the P&C will be more a liquid one, rather than compared to the life that is more a stable long-term. So it will be the stock and the bonds. And then the third point is about the street makeup. So on the life side, will be dominated by a lot of big company. However, on the PNC side, so as of 2014, there is a 214 Canadian PNC insurance is playing in the market right now. Yeah, so that will be how they are different in the size of the company. And then in terms of the rates, so from the life, that we are kind of charged a flat rate. For example, in a 20-year term life policy, you pay, let's say, 500 per year every year for 20 years. However, in a PNC is different. So uh, when you're driving a car, if there's an accident happens, then your next year's premium, it will be slightly different than this year's premium. So I would say the rates for PNCs fluctuated based on the driving experience and other factors as well. The last one, the differences will be, does it mandatory? So for life, it's not mandatory. However, on a PNC side, it does quite often. I would say for the auto is definitely for auto insurance is mandatory because that it ensures that everyone on the road has protections, and then on the auto side, because it's mandatory, and then we it's often kind of regulations will kick in that they will be heavily regulated because the government don't want uh, us to cut the price too much or too low or in a way, so that everyone can be insured. And then for the property side, let's say that when you go to the mortgage, sometimes they will ask you for is a home insurance. So it will be saying that for the property is not mandatory, but you will always being asked in a way. So I would say it's that's the major differences compared and life and PNC here. So that will be all. Any questions?
I've got a question.
Yep.
So obviously, between the different provinces, there are major regulatory differences when it comes to auto insurance. Like if you look at Manitoba, Saskatchewan, BC, there are crown corporations like MPI, SGI, ICBC that manage auto insurance. And as you mentioned, it's compulsory in many provinces, and the regulations for different accident benefits vary from province to province. So my question is, how does those provincial differences impact the work that actuaries do? I
Yeah.
imagine on the product side.
Yeah, no, that's a great question. So they would have quite a large, so the I guess the approach is often going to be similar. You're modeling coverages, the losses on those coverages, and each province has fairly similar structure, but the end results and sort of what you're looking at. So, for example, like you said, BC has ICBC, so they're the only ones providing primary or bodily injury and accident benefits coverages. So the injury coverages, or the mandatory coverages, as they call them. However, in BC, the market is open on the auto physical damage side, so collision and comprehensive coverages. So when your car gets damaged in an accident, so you may be focused as a pricing actuary on looking at those coverages, understanding how we can sort of make the best rates on those, and make sure that we are capturing what the risk is in BC. So there might be slight differences that we look at. Whereas somewhere in Ontario, it would be insurers providing all of the different coverages. So we would be modeling those. And it also, I guess, in terms of the regulatory environment, it also affects how we get those rates in, so how they become effective. So for example, for the BC example, it's an open kind of free market on those coverages. So you would do the analysis, you would look at the different trends, emerging costs, those sorts of things, and you'd come up with your price, and you would be able to implement that right away and charge that. Whereas somewhere in Ontario, they have a much stricter regulatory environment. So you would still do those analysis on all the different coverages, but then you would have to prepare what's called a rate filing and send that to the actual government and say, here is what we're seeing, here's what we think we need to charge. And they have to sort of sign off and agree on that. So each province will have a different requirements for how you can actually put in those rates into effect. Some are much more strict, like Ontario or say New Brunswick. Some are almost no barriers to putting your rates, like Quebec almost has completely free when you want to change rates, you can do so at your own discretion. So depending on the province that you're working on, you'll often be doing a very similar amount of analysis and similar type of analysis, but how you can actually make those rates get into effect would be quite different. There's also a little bit more opportunity, I would say, to do maybe some more advanced modeling, those types of things on provinces where there's a bit less regulation, just because it's a much easier to explain simple models, those types of things to a regulator and have those accepted, rather than putting through maybe a big machine learning GBM-based model that is very hard to explain, more black box type. You can use those types maybe in somewhere like Quebec, where you can do like optimization, advanced modeling, those types of things. They would also, the other thing I'll say just before we move on, is that the jurisdictions would dictate what you can actually charge on. So not everywhere you can use the same variables. So for example, in the Atlantic provinces, you can use credit score as a rating variable. If somebody has higher or lower credit score, you could charge more or less. Ontario, that's not allowed. And so as a pricing actuary, not only do you have to understand how the risk varies with different types of risk profiles, you also have to be aware of what you can actually charge on. Because if you tried to propose that, obviously it wouldn't go through. And so you need to be able to say, like, here's the variables we can use, here's what we think is actually predictive, and here's what we want to charge. So hopefully that gives you a good kind of overview of the different challenges by region that you might face. I'm not sure how we want to do.
Yeah, I think I had Darsh next, and
Okay,
then Alexander, and then Kira.
sounds good.
Hi, I hope you can hear me. Thank you for the presentation. I was actually surprised to know that there's 250 P&C insurance companies in Canada. Now, my question is, how does a company have a competitive advantage when there's so many competitors in the market, and like the life side of things, specifically technologically? Thanks.
Yeah, no, that's also a great question. So there are certainly larger companies that you've probably heard of, like Intact, Aviva, TD, us. Like we're one of the major players. So there are advantages for sure, like economies of scale that we would get. However, what you'll often find is that companies can specialize. So not every company is going to offer, say, cyber insurance. Not every company is going to offer farm insurance. And so you'll see a lot of smaller, what they're called mutual companies, where the policyholders almost participate in the profits of the company, for farms or other commercial type activities. And so largely the biggest insurers will probably sell just about all types, but they might not sell everything. And so you can really differentiate yourself, one, by having that specialization. There's certain products or even types of markets. Like if you want to specialize in auto for, say, long haul trucking or things like that, you can specialize, or young drivers or motorcyclists. Like there can be companies that can do that and really find their way into the market as from that. And there also can be advantages from just the service. So sometimes two companies offering the same price, even though one might be more well known, people might have a better experience with a different one, a smaller insurer who's offering a similar price. They might have like that word of mouth, or brokers that like to put insurance with certain companies, because they know even if it might not be the cheapest, they might be the best for handling the customers. And so you can also separate yourself from the rest through that. So those are a couple, I think, ways that smaller insurers still exist. The market is, I would say, consolidating a bit. So I think there's probably just under 200 companies now, still quite a bit. So still a very big competition. But there's becoming, as companies get bigger, absorbing more or sort of acquiring more companies. So there's a bit of consolidation going on, but still a lot of players in the market, which I think is interesting, because you can go to two different companies and get a very different experience doing what would be the same role. I think
Awesome.
Alexander is
Yes.
Yeah. My question is sort of similar to the last, but I was wondering, how does market competition and conditions affect pricing towards premiums, especially if you're dealing with two or more insurance companies offering the same coverages
Yeah.
or services?
Yeah. So that's a very good. So the market competition in terms of price can be a very big influencing factor. So as part of pricing, that's a big consideration is how does this put us competitively with other insurers? And so we'll look at the loss data, but often we will also look at competitive analysis. So that could be how often are we the lowest quote or in the top 5 lowest quotes given to a customer? And we may see that we should be raising our rates by 6 or 10%, but we think that we want to maintain, say, the growth that we've been seeing recently. And so we only want to increase our rates by 5 of that 10%. So it's often a trade-off between your rate adequacy or your bottom line, your profit, or even just your loss ratios, and your top line or your amount of volume that you're writing, the business that you're writing. And what you can do is you kind of look at those two competing things. How do we sort of improve our rates, get our sort of profitability and rate adequacy to where we want to be, while also still being a competitive option. And so I talked about one of those options is just looking at when are we cheap, when are we expensive, and maybe having that in our mind. Another big one is segmentation. So although on average we may be more expensive, there may be sections of the market that a company thinks we can price these better. Like we understand something that another company doesn't. And so they might make rates cheaper for, say, young folk, like young drivers, or certain vehicle types, maybe electric vehicles. They have some more thoughts that these vehicles are actually less costly than the market thinks. And so what some insurers do is they will have specific segments where they're cheaper and they'll grow in those segments. If they think that they're correct in pricing those segments, they will grow and could be profitable. On the flip side, if they think that these are good segments and they're wrong, then they might be growing in an area where they're very likely to make a lot of losses. The last thing that you can do to remain competitive is looking at your existing book and saying, how much rate or how much premium do we think we should be charging to these people to make sure that they don't exit, they don't go shopping elsewhere. And so you can look at things like sensitivity analysis, like elasticity, those types of things to say, if we send them a 5% rate increase, we might lose 5% of the book. If we send a 10% rate increase, we might lose 25% of the book. So you can do analyses like that also to remain competitive and sort of keep an eye on how do you write business, maintain business, while also trying to achieve your goals of sustainability or adequacy. So hopefully that gives you a little bit of an insight into it. I think Kira.
Yeah, so I was just wondering, like, you can let me know how true this is, but I've heard that, like, if you work in P&C, you could potentially be doing more coding than someone who works in, like, with the SOA actuaries. And so I was just wondering, like, I've also heard that, like, it would be good to know, like, SQL or R if you're looking to get into P&C. And so I was just wondering, like, if there is, like, a good language to know or, like, do a project in, or, like, how much coding you do day to day, like, if you code at all. So, yeah.
No. Maybe I'll start and then I can pass it over to Phoenix, but definitely it's a very big asset being able to have experience in coding. SQL, as you mentioned, is a big one. A lot of companies, especially larger companies, are moving on to like the cloud computing services, so Google Cloud platforms, things like those, where your query language is going to be some form of SQL, and all of the data is going to be stored there. And if you want to retrieve and manipulate data, you'll have to have a pretty strong understanding of SQL to have that, especially in a P&C, because we get thousands of data points every day, things like claims, quotes, just customers on our systems existing, not having claims, payments, if they miss payments, all those things are data points that we might need to access and use in some type of model. And then the other thing I would say is a very popular R, I think is a good language, but I think more and more Python is becoming sort of the language of choice. It's much more versatile. You can do a lot more building in like packages and automation, and it integrates nicely with a lot of these cloud computing options. And so I would say Python is a very good resource to have. And in terms of that, I don't know exactly how much modeling is done at the life insurance, because I've never worked at a life insurer, but I can tell you there's lots and lots of modeling going on at a P&C company. They're going to be looking at modeling for pricing, for retention, for quote to binds, for even modeling on the customer quote journey. If you have, say, an online website, when are people leaving? When are they staying? All of those things we build predictive models on to help us make decisions. So there's certainly a lot of use cases for modeling and working in coding. Phoenix, I don't know if there's anything I may have missed with your.
No, I think Python and those are the key one put into my mind, that because the cloud that we are kind of moving to that, and then we start to, you can do a cool thing about is that you put your Python on the cloud and then you schedule a run, and then you just kind of pull the data as that from the cloud, and then you schedule it. Let's say you monthly run it, and they'll just kind of run it automatic, and then just it will run the model, and then it will kind of write up an email by itself. It's pretty cool.
So I just want to be conscious of time, Daniel. I don't know if we want to we can keep doing questions. I'm fine with that, but I know you had some networking thoughts.
I have no problem if we want to continue with the open panel questions. Conversely, we could also go straight into breakout rooms. So I think maybe let's go with these three, Louis Pascal, Nolan, and Francis. And then I'll try and reserve a couple of minutes at the end for a little bit of breakout room networking.
Yeah, that sounds good. That sounds good.
I'll try to be quick with mine. So obviously in the context of Definity demutualized from economical, I don't know how many years ago. So my question is, how does the difference between mutual insurance companies and stock or not mutual insurance companies, how that changes risk appetite, and how that difference in risk appetite will affect the work that you do as actuaries?
Yeah, no. So one of the big things is that when you're a mutual company, your primary concern is like solvency. So you want to hold enough capital and have your premiums and everything set so that you're very sure that your policyholders, who are kind of like your owners, are going to be able to get paid out in the event of a loss. And so they usually hold much higher amounts of capital for the given risks. And that's kind of like a safety net. And they're not answering to like shareholders or anything like that. When you become a public company, share-based, now you're kind of answering to market expectations, shareholders, and your risk appetite kind of increases because you need to be able to deliver returns to the people that are investing in you. And that's reflected in a few different ways. One is that your capital, you usually want to deploy more capital. And so what that means is you're investing more into your own abilities, whether it be systems or capabilities like upgrading your storage, like data to cloud platforms, things like that can really enable you to do more. you're using that capital. You're not just holding it in reserves. It may be acquiring companies. So like Definity, some of you may have heard, we acquired Travelers Insurance Company. So Travelers, a company of Canada. So the Canadian division of it. And so that was a big acquisition and a sort of a strategic use of capital. Obviously, that presents more risk, but it's kind of the way that we would continue to grow and maintain our level of growth and profitability that we want. It may also mean that we're more say aggressive in terms of growing in certain markets, taking on business, those sorts of things. We can be a bit more leaning into, we want to write more business, we want to grow, we want to ensure that we're a big player in the market. And so really your risk appetite sort of increases. You have more deployment of your capital. You're holding closer to the regulatory requirements rather than just the ensuring total solvency. And so overall your risk appetite increases. For us, it means that we're doing more dynamic rate changes. We're taking much closer looks at the profitability and our books of business to see where can we get competitive advantages and those sorts of things. And a mutual company may not be as concerned with that. They're more concerned with making sure that their policyholders at the end of the day are going to be paid out when they need to, and holding that amount of capital to ensure that even in the worst events that they'll be solvent to. So hopefully that gives a bit of a insight into the risk appetite. And then I think we have Nolan.
Hi, how are you guys doing today?
Good. How are you doing?
Very good. Thanks for asking. So, my question is, I've never worked in an insurance company, but I can imagine that in one, there's many different moving parts and many different departments in an insurance company. So, this is a bit less specific to PNC, but I'm still very curious of how do actuaries interact with other sections of an insurance company, such as the marketing team or claims and other sections, and how do those interactions affect work efficiency, pricing, or other aspects of the actuarial job?
Okay, yeah. Phoenix, do you want to go for that one, or do you want me to
No, you can continue, I think.
What's that, sorry?
No, I think you can continue, honestly.
Okay. Yeah, no worries. So we went over a few different, maybe if I back it up here, a few different functional areas, and we'll just go to this screen here. So there are a lot of different functional areas of P&C specifically. I'm not sure all of these exist to the same degree in a life insurer, but some of the main different ones I would say for P&C are going to be claims and product. And so actuarial works very closely with both of those, because depending on your role, you need to understand both what are we selling in order to price it properly, and also what's happening in the market in terms of how are claim costs evolving, are injuries becoming more severe, technology's improving in cars, and it's getting more expensive when we pay out claims. And so we work a lot with these various departments. So I'll just give a few examples. So maybe for claims, they might be seeing theft going up. We're getting a lot more reports of theft. And so they would be sort of the first ones to see that. They'd be the first line of, hey, we're getting a lot of theft claims. Those are increasing. And that was a big problem in Ontario just a few years ago. Theft was extremely on the rise. And as an actuary, you're often looking at historic data. You don't always have maybe a view of what's trending in the market if it's not trending in the data already. And so what that can mean is that they'll alert the actuaries, the pricing actuaries, or the reserving actuaries, and say, hey, thefts are going up. And a pricing actuary might say, okay, that's good to know. What we're going to do is certain coverages that cover theft, we're going to have to increase rates on those, because we already know that those are going to be, current rates aren't enough. We're going to predict, and we might do an analysis with them to say what kind of cars are getting stolen more. And so we can properly price for the risk of those cars. Reserving, they might need to say, hey, we need to hold more capital or more reserves to cover this increase in theft. And so it really enables us to do, like in this example, a lot better and more fair pricing, and then make sure that our analyses are reflective of what we think is going to be happening, not just what we might have seen in the past. You mentioned marketing. And so what we can do with marketing is we can say, what are certain segments that we think are desirable customers? So we might work with product underwriting and marketing on that. We say, can we identify certain types of customers that there might be, maybe not necessarily more profitable, but they might have more consistent loss patterns. They're not getting into as many large collisions, say like a newer driver, or types of vehicles that we find are very consistent in terms of their costs. And so we might have certain marketing initiatives to try and attract those types of customers. We might see that customers of a certain group, like university grads is a very common one, often have better experience and are more insurable, so to speak, than other types. And so we might work with marketing to launch like, hey, we're giving a discount on graduates. If you're an alumni from a university, you could save with us. That's a very common one. Or even something like if you're an engineer, there may be savings for certain companies. They give that. And so that really working with these companies allows us not only to just look at the data, but also see where can we put in modeling and use that data to make decisions, and also get an eye on what are some of the market conditions, what are trends, how can we look forward and incorporate that into our analysis. So those are some examples. You'd work with all sorts of different departments, but I would say it really makes our job, I would say, more interesting, for one, because you get exposure to those. And two, it allows us to do a better job when we're more collaborative, because we're not just working in isolation. Like all these parts have to be running successfully in order for the company to operate. So if we're making pricing changes, we need to tell the product or marketing team, hey, we're lowering prices here. Maybe that's the opportunity that you need to do that marketing for that group. Or if claims is seeing something, they say, hey, maybe we don't want to grow in here. All these vehicles are getting stolen. And we say, okay, let's pull off on marketing to that group, or let's increase the prices for that group. Or we might even put underwriting restrictions and say, we're not going to insure those until we can understand what the risk is. So
Thank you very much.
no worries.
Appreciate it.
And then last is Francis.
Yes, last is me. Hello. I know previously we talked about like SQL and the Python that you guys use, and also the potential to use the black box algorithm to determine rates in Quebec. And I was just wondering if there's any like technological shift that you're seeing in the industry right now, like specific tools, softwares, or if there's any like innovative practices that your team has adopted recently to just kind of like change your day-to-day operation structures a little bit.
Yeah, no, for sure. So two of the big ones, and one's already, I would say, old at this point, which is kind of interesting, is the introduction of machine learning models. So before, and probably in lots of your classes, and maybe I'm just old now, but we didn't have any when I was going through school. But a lot of focus on GLMs, so building the linear models, very powerful, very good, allows you to look at many different variables at once. But the advent of machine learning, those like the GBMs, the EBMs, all of those different kinds of tree-based models allowed us to, one, make much deeper connections between different risk factors and the actual data, and two, significantly sped up the process at which we could do it. And so we could build the structures of models and then really let the machine learning go, and it would develop loss cost models or whatever types of models, tell us which variables are important, do the selection, and output these large, complicated models that we could then use for other purposes in the company. So that was the first big, I think, shift, at least that I've seen. And then the second one is probably all of you are familiar with is AI. And so AI is becoming an everyday tool, I think. So you could use that to help you, for example, understand a data set. You could build like an agent, they call them, to learn all about this different, like a set of data and read all of the metadata on it and all the documentation. And then you could ask it questions and it tells you, like, I'm looking for this, and says, hey, you should be going here. It could sort through all types of like historic filings and regulatory statements and things like that. And you can say, like, I'm trying to find this. When did we do this? And it can give you those things. It can also help automate things and give you suggestions if you're looking for, say, what are the regions in Alberta that are most likely to get hail? It can give you a starting point and can be very valuable. And so one of the interesting things that I think most companies are doing is that AI isn't replacing actuaries. It's not doing the work that we're doing. Like, it might be able to help build models and code and those sorts of things. Like, it might help you draft up code, but you're ultimately still doing that work after to check it, make sure it's running correctly, it's doing the right things, picking up the right decisions, all of those things. And so it's not so much replacing an actuary, so much as enabling them to do more. What took you 5 hours might take now 10 minutes because you can put it through Gemini and get the answer. And then you can use that to drive more insights rather than doing just more of the grunt analysis. And so those are the two big ones. And AI is still ever evolving. There's a lot of obviously control risk and things like that involved with AI. So its evolution and use in insurance companies is still rapidly growing. But it's growing at a pace where sort of the controls, the management of it, those sorts of things can keep up. And so it's not totally exploding and taking over everything, but it is growing at, I would say, a very, very quick rate in terms of its use.
Thank you.
Yeah, no worries.
Amazing. So before we wrap up here, I just want to say a huge thank you to our hosts from today, Kieran Hendrickson Gracie and Phoenix Hugh. We'll give you a nice virtual applause. I know it's not the same as in person, but it's what we can offer. So thank you so much for being here. Thank you to everybody who is able to tune in either in person or if you're watching online. Thank you very much. And as always, a big thank you goes to the Canadian Institute of Actuaries. After all, this webinar series is powered by the CIA. So I am aware of the time. I know we are 5 minutes over already. I will cut the recording here, but if Phoenix and Kieran, you guys are available for maybe 10 minutes of networking, is that all right?
Yeah, that's fine. That's
Yep.
fine.
Fantastic. So I will cut the recording.